Hello everyone, we're gonna start. Dzień dobry, pani pani. Mami problem, nie mówimy po polsku. Don't worry for the Polish speaker. We're gonna record this webinar, this first Keewe webinar that we're doing today with Marex, and it's gonna be translated in Polish. Today we'll talk about a very practical topic: how companies can protect their profit margin when commodity prices move quite sharply. Many companies are already used to manage currency risk, but commodity price risk is often less familiar, especially for SMEs and mid-sized companies. The objective today is not to make this topic complex. On the contrary, we want to make it simple and practical. We will first explain why commodities markets have become more volatile. Then we'll show how this volatility can impact a company's margin. Finally, we'll go through a concrete example, fuel price hedging for a company in Poland. By the end of the session, you should have a clear idea, hopefully, of when commodity risk become a real business risk and how hedging can help manage it. To be able to offer you this type of solution, we've built a strong partnership with one of the main actor, if it's not the main actor of this industry, Marex Solution. So before going deep into the topic, I'm going to let Camille, we have the honor to have Camille with us today. So Camille, I let you introduce yourself and introduce also Marex Solution.
Thank you, Pierre, for the introduction. Good afternoon, everyone. So I'm Camille. I'm 37 years old. I have joined Marex in March 2020, just at the beginning of the COVID, to build the OTC division on energy and metals for European clients, and especially a focus on corporate clients, which are French-speaking, so French, Luxembourg, and Belgium. Before joining Marex in 2020, I worked 8 years for the French bank Société Générale. I was in the Paris office and I was in charge of covering French clients as well, and especially small and medium-sized companies, which were clients of the retail bank Société Générale. I'm now, sorry, Jeff. I would like now just to speak a little bit about Marex, so the company I'm representing today. So Marex is a diversified company, a financial and UK company with a focus on commodities. The company has been created in 2005 and have generated in 2025 2 billion of revenues. We are providing to corporate clients all over the world a full service on commodities, from execution to clearing and hedging solutions. I work today for Marex Solution, which is the OTC division of Marex Group, and we provide hedging solutions to corporate clients through a bilateral relationship, which means that you will face Marex Financial UK Limited, an FCA and UK entity.
Short introduction on my side too. For those who don't know Keewe is a financial platform built for SMEs and mid-sized companies with international operation. Our objective is simple: to make financial operation easier, more efficient, and more sustainable, and the best, cheaper. Today, Keewe support companies on several key topics: international payments, multi-currency accounts, FX risk management, treasury solution, and now commodity risk management, thanks to the partnership we have with Marex. The common point between all these topics is simple: companies need more control over their financial flow and their risk. For many SMEs, these tools were historically difficult to access, even more in the Polish market. They were either too complex, too expensive, or mainly designed for large corporates. Our role at Keewe is to make this solution more accessible, more understandable, and more practical for companies that need them. On my side, I worked for 10 years at BNP Paribas headquarters in Paris, serving mid and large corporates. During those 10 years, my role was to structure tailor-made financial hedging solutions to help companies manage their market risk, including fluctuation on commodities prices. So today, the goal is to make you a clear view of how is the commodities market, how it works, and how we can help you. So let's start with the beginning, Camille.
Yeah, exactly. So I think today it's very simple to hedge FX. You can easily find in the market several liquidity providers to assist you in the hedging of FX. On commodities, this is not really the case because the commodities markets are more complex. And that's why it's very important today to be supported by experts on the commodities market. And I think, and I'm sure that Marex is the best candidate today to assist you, because the DNA of Marex is clearly the commodities. This is what we have started with 20 years ago, and this is what we will do for the next 20 years.
So let's start to speak a little bit more in details about the commodities market, price shocks, and we're going to, of course, speak a little bit about that, about the situation that we currently face in the Middle East. But price shocks are not new. Commodity markets have always moved. But over the last years, we have seen shocks that are more frequent, more intense, and sometimes longer lasting. There are several structural reasons behind this. First, of course, and everybody is aware about that, and this is also the strong part, a huge part, maybe the main part of the DNA of Keewe is to make all the operation more sustainable. The first reason is the climate change that affects agricultural productions. Higher temperatures, lower yields, extreme weather, and crop diseases that can reduce supply and push price up. Second, the climate disruption also affect logistic and production region. Floods, drought, storms, heat waves can disrupt every supply chain. Doesn't matter which industry we're speaking about. Third, and this is, let's say, unfortunately a hot topic, and not only since the Middle East war has started, but since several years, the geopolitical tensions are a major driver on commodities shock. Conflicts, embargoes, trade war, or simple market fears that can create sudden price spike. Finally, and this is just the nature, finally, some resources are becoming structurally scarcer, meaning that this is particularly relevant for certain metals used in the industry and energy transition. You have less and less assets available in the ground, let's say, for the metals. For companies, the conclusion is important. Commodity volatility is not like an exceptional event anymore. It's becoming part of the normal business environment. So let's have a look of the main recent example. I'm gonna start speaking, and then Camille, I will let you, because I guess that this is a hot topic when it comes to the oil shock of 2026. But for example, we've seen with the beginning of the war in Ukraine in 2022, we've seen the European energy crisis. We have the feeling that we are more or less in the same type of situation. It's not coming from the gas, it's coming from the oil today, but more or less the same situation. After the beginning of the European energy crisis in 2022, the wheat market has also strongly been affected by the war in Ukraine, because the Black Sea region is one of the major export area. So the disruption in that region immediately created pressure on global wheat prices. But then you can also have, and it was the case in 2024 for cocoa, which is another strong example. Prices increased dramatically, creating major challenges for food companies and chocolate producers. And this has been coming from some diseases that have been linked also to some climate change and climate disruption. And then let's say the hot topic of 2026, Camille, I'll let you give us some words about the situation and how your clients are facing this energy crisis.
Exactly. So as you all may know, since the beginning of the 2026 years, we are living a crazy situation on the oil market as the Iran and the US entered into a deep war, which has been incredible and which is causing a lot of disruption and a lot of tensions in the Middle East. We especially with the closure of the Strait of Hormuz, which is the main passage of oil products. So since the beginning of the year, the Brent ice, which is the main reference of oil in Europe, has increased significatively from $60 to more than $100 in a couple of days. And the volatility and the intraday volatility has been amazing. For now, the situation is not yet finished. And we think that we will keep seeing a lot of volatility until the war is finished, which is probably not happen before end of the summer, I guess.
So the question is, because it's a very wide topic, what do we mean by commodities? I will let Camille explain you what are like the three main families of commodities, but just a first definition, we are talking about raw materials or basic products that are used in the economy. But stay with us, even if you're not buying some raw materials, because it's not because you're not buying raw materials and that you are like buying some finished product that you don't have any commodity risk that can create some negative impact on your net results.
Exactly. So on the commodities market, we have three main categories of commodities. So the first one is what we call the energy sector. So in the energy, you will find all mainly 50 different references, from crude oil to fuel oil to distillate products to gasoline. You will find also in the energy area all the gas and power underlyings. Main reference are in Europe, but we have also the US references of gas. And in this category, you will find also biofuels, carbon commodities, and also freight commodities. I will not give you the full list of all the underlyings we can do on energy, but be sure that we have more than 50 different references which are tradable on the market. We will give you more details later. The second category you can hedge is the metals category. So in the metals, you will find mainly base metals, so copper, aluminium, zinc, lead, nickel. You will find as well precious metals like gold, silver, platinum, or palladium. And last, you will find some steel references, iron ore, and different ferrous metals. The last category we will be able to assist you is what we call the agricultural commodities, where you can find all the grain and seed like wheat, corn, soybean. You will find also the stuffed commodities, which are mainly cocoa, sugar, cotton, and coffee.
And one thing which is also important to say is the fact that for us, the most important is to know, to have the more information as possible. Meaning that, for example, when I was working on commodities at BNP Paribas, we were talking with companies that were buying some petrochemicals. And in 2014, when I started to work on commodities, it was not possible at all to hedge some petrochemicals like styrene, ethylene, or this type of stuff. But the commodities, the forex market is quite mature. Everything is possible, is already possible since decades. On commodities, this is the magic of this industry, is the fact that the things that are not possible today could be possible tomorrow. So keep in mind that it's important for us to get the information, because even if we are not able to assist you today, it's quite possible that we're going to be able to do it in the future. Then one important topic, Camille, if you can explain why not every commodities can be hedged.
Yeah, so it's very important that you clearly identify the physical exposure you have, and you find the correct underlying, which will give you the perfect hedging. Okay, so in order to proceed, you have to identify first the market, so the index. For example, on the energy, the main index are ICE or Platts. For metals, the main indexes can be LME or LBMA. And for agricultural products, the main index will be CME or Euronext. So it is very important to start with that, okay? The second identification will be to identify, in more details, the publication of the underlyings. Okay, so for example, you can buy the mean products, or you can buy the high products for energy, and for metals you can buy the cash price or the 3 months price. So it's very fundamental, I would say, that you hedge exactly what you are buying or what you are selling, okay? And the last part is that you have, of course, to identify the good underlying. If you are buying grains, wheat, you have to hedge with wheat. You can't hedge with something else, okay? As Pierre said before, we are today able to trade and to assist you in the hedging of a lot of different references, but the list is not exhaustive. It means that if 10 years ago, for example, an underlying was not able to be hedged, it will be probably today, because we have more clients asking about this, because a market has been recently launched, for example, etc., etc. So don't take for granted what has been what you have been told a long time ago, saying you that it's not possible. No, keep in mind that you can ask us. We will try to find the best underlying for you, and if the underlying is not available, we can maybe try to do correlation study to find a good proxy of your physical exposure.
And I will add just one thing on this slide. Of course, when you see all of these steps, you maybe think that it seems too hard, too complicated. This is exactly the aim of Keewe, and with the partnership with Marex, being able to work with you from scratch, meaning to work with your purchase manager, to look into your contract, to identify the perfect underlying, which is linked to your financial risk. And so I've been used to do it for 10 years at BNP Paribas. We have the chance at Keewe to have several commodities experts. So once again, the goal is not to be only selling hedging. We're here to be on Keewe's side, to be a real advisor on this topic. Let's move forward, and the most important, the question is how important is the commodity in the total cost base? This is the first question you need to ask yourself. The second one, and I'm going to go back into the details. The second one is what's the company's margin level? And the third, can the company pass prices increase to customer and how quickly? These questions are more important than the size of the company. A smaller company with high raw material exposure and low margins may have a much higher risk than a larger company with more pricing power. Commodity risk is often managed by procurement team, purchase department. They negotiate with suppliers, they compare offers, they try to secure the best purchasing condition. That is, of course, the most important. But the financial impact goes beyond procurement. If a raw material represents 40% of the cost base and its price increased by 10%, the total cost base increased by around 4%. For a company with high margin, it could be manageable without too many problems. But for a company with an 8% margin or a 3 or 4 points increase in cost can seriously reduce profitability. In some cases, it can also wipe out the margin. This is why CFO and business leaders should look at commodity risk as a margin issue as they are doing it on the currency or on the floating rate. So the question is not, do we buy this raw material? The question is, can a price movement in this raw material materially damage our profitability? If the answer is yes, then the risk should be measured, monitored, and potentially hedged. The exposure is even stronger when, and we're going to see that now, when selling prices are fixed. It's really important, and maybe it's clear that the most sensitive business model is this one. The company buys raw material at market prices, so input costs can move days after days, but at the same time, the company's selling prices are fixed. This happens in many situations in a lot of different sectors and industries. For example, let's take a company that defines annual price list in October for the following year. So, for example, in October 2025 for the selling prices of 2026. Or you can also take the example of a company who wins a tender with fixed price for the next 12 months. In all these cases, the raw material price increases. After the selling price has been fixed, the company, of course, cannot adjust immediately, meaning that the increase of the purchase cost will directly go into the margin. So the longer the contract period, the greater the risk is. A 3 months exposure is one thing. A 12 months or 4-year exposure, which could be the case, for example, in the automotive supplier industry, is a very different situation. For these companies, hedging can be a way to protect the margin that was assumed when the commercial contract was signed. And this is, at the end, the most important. Same on Forex, because you, as a company, your core business is to build product, to build goods and services, and to sell it. But at the end, if you have a financial market that happens or triggered, all the work you've done could be destroyed or at least damaged by some financial market risk. But so, if you have this type of business model, meaning you fix the price for the coming year, for example, at the end of the previous year, it's definitely something you need to look at. But in a lower extent, for the company who have like variable selling prices, so variable purchasing cost, variable selling prices, it's still not risk-free, meaning that you can have, and we're going to go back into the details here, but for example, if you buy some raw materials let's say in January, and that you sell them only 4 months later, you understand easily that if, for example, you buy a raw material at 1,000 USD and that 4 months later the price is 700 USD, it's going to be harder for you to keep your commercial margin. So once again, the most important to keep in mind is that every time you are buying with a variable price and you are selling with fixed price or selling to variable price, but with a lag between the purchase date and the selling date, you can have a financial risk. So the most important today, and the right question, because we hear a lot of times at Keewe, and it was the same in the past, some CFO asking us, will prices go up or go down? First, it's a very difficult question to answer. I'm sure Camille, same than me, you're not going to answer to that because nobody knows. And to be honest, if we knew, we wouldn't be there speaking with you. We would be in holidays all the year. Nobody can predict the commodity market with certain 100% sure. It's not the case on Forex, and I think it's even harder on commodities. The better question is different. When does the price movement become a real financial risk for our business model? Once the risk is identified, as we've explained with Camille before, the company has several possible tools. Here on this slide, and this is something you know better than us, there is no single perfect solution to hedge or to manage the commodity risk. So a good risk management framework usually combines several levers. The first one is to fix purchase price with suppliers. This can give visibility, but it depends on supplier willingness and may include a premium. Keep in mind, first, I know that in a lot of industry, it's very hard and very tough and not usual to be able to have a fixed price with your supplier. And also keep in mind that if you have a fixed price with the supplier is not crazy and is managing his financial risk too. So it's also possible that on the other side, the supplier is trading with us or with someone else a hedge and could add a premium on that. So that's always better to have like two independent contracts. First, the supply contract. So of course you need to buy the raw materials, and Keewe or Marex is not pretending that we're going to sell you your aluminium or your wheat. And on the other side, the financial hedge. The second lever that we see with our clients is indexation clauses in customer contract. Of course, that's the best case scenario, but easy to add some indexation clause in some contracts, and it could be a deal breaker for a lot of your clients. The third one is supplier diversification, of course, for obvious and a lot of different reasons. And the last one, and this is why we're here to speak with you today, is financial hedging. This means using a financial instrument linked to a benchmark. You can stabilize the economic impact of price movements, and we're gonna see just after how. So let's now define more clearly what financial hedging is and what it's not. Camille, I let you.
Thank you, Pierre. So it's very important to understand what is the purpose of about financial hedging. It's to reduce the exposure of your company to the market volatility. In fact, by entering into OTC derivative strategy with Marex through Keewe, you will not buy the commodities at the lowest price and sell at the highest price, but you will protect your company against a market increase or a market decrease, or and consequently, you will secure your margin. So it's very important to identify properly your risk and your exposure, to understand exactly what you are looking for, to design the good limits, and to enter into the good hedging strategy in order to protect yourself at best. So the main goal of hedging is that you have a physical exposure to the increase or to the decrease of the market, and you want to protect it by entering into a derivative strategy. You have to keep in mind that all the instruments we will offer you are financial instruments. It means that we will never deliver you any physical commodities, okay? The relationship and the hedging we are offering you is a pure financial hedging, like an insurance, and we will not interfere between you and your supplier.
Sorry, I was on mute, and this is a very important information, and I'm gonna go back on this, because what we're gonna do now is to take the case study, hot topic 2, of fuel price hedging. And as you said, Camille, we are not going to change anything in the relationship you have with your suppliers. Meaning, for example, we will explain you how we can hedge fuel price hedging, but it won't change the fact that for example, if you are a logistic company, your truck driver will still go to Orlen, and they're not going to say to the petrol station, I'm sorry, I have a financial hedging with Keewe, so I'm not going to pay this price. This is not how it works. So let's see a little bit how fuel prices hedging in Poland could work. The first thing is to understand what we're speaking about. You know that it's the case in every country, France, Poland, everywhere. The price you pay at the petrol station is not only the price of the commodity, meaning the diesel price you pay is not 100% diesel price. What is it? Of course, you know that, and nobody is happy about that. A huge part, a significant part of the fuel oil price that you're going to pay at the petrol station, doesn't matter the supplier we're talking about, is tax and statutory charges. The third, the second one, the second main one, and we're gonna see that just after how it's balanced in Poland. It's crude oil and refined products. So here we speak about the raw material. So here we speak about the commodity, and here we speak about the part that we can hedge, but we're gonna go back a little bit more in details on that. Third, you have the exchange rate, of course, because Camille explained that, for example, the Brent, which is the main index and the main reference on the commodity market for crude oil, the price is benchmarked in USD. So same in France, same in Poland, the exchange rate will have an impact. And then it's the domestic parameters, meaning the margin that the supplier, like Orlen, for example, is adding. Here, for example, you can see, depending if we speak about diesel or benzina, the different parts that I was speaking about before. And you can see, once again, nobody is happy about that 50% of the price is the taxes. And to be very clear, and everybody would be happy if we would find a magic way to do it, but we are not going to hedge the tax. Here, we're going to hedge 100% the commodity and the fuel oil price. But how to do the link between the price you pay for diesel or benzina and a market index? I will let Camille explain a little bit, but all this information that Camille will explain, you can find them, for example, on the website of Orlen, so it's official.
Exactly. So if you are a transport or an industrial company, you have today in the financial market the possibility to hedge yourself with two main references. The first one is the Platts ULSD, so low sulfur diesel 10 ppm, CIF Northwest Europe. This is the main reference for diesel in Europe, and we have run several correlation studies with the Polish prices, and the correlation is almost 100%. So it's a very good edge if you are using this reference. The second underlying you will be able to trade in the financial market is the Platts gasoline 10 ppm CIF Northwest Europe. This reference is less liquid, I would say, than the diesel one, but it is also very well used by transportation companies, and you will easily be able to do some hedging on this ref. So both of these underlyings are good names if you want to hedge your diesel and gasoline exposure.
And to show you the link between the price you pay at Orlen, or doesn't matter which petrol station brand we are speaking about, here you can find, you can see if this chart compares the Polish diesel prices with the ULSD 10 ppm benchmark that Camille was talking about. The blue line represents the Polish diesel pump price. The golden source of these prices are the Orlen website, and the black line represents the ULSD benchmark converted into into the zloty. We can see that the two lines move in the same direction. You can see that the correlation is obvious. When the benchmark increases, the Polish diesel prices rise too. When the benchmark falls, the Polish diesel prices fall. The difference between the two lines, of course, because you see that it's not the same price, the difference between the two lines is mainly explained by taxes and other local components that we were speaking about before. So now that the benchmark is identified, and remember what we said at the beginning of the presentation, it's the same for every commodities. First, we have to identify the benchmark. Let's clarify why a company and how a company could hedge fuel prices. So it's going to be, for some of them, very obvious things what I'm going to say, but the purpose of fuel hedging is not to predict the market. Once again, there is no, it means that I'm going to win with your hedge, or I'm going to lose with your hedge. I think the usual, even it's not the same, the best and the usual way to explain the hedging, it's insurance. You are trading and you are building with this risk policy management, more or less an insurance to protect your commercial margin and at the end your net results. The purpose is to protect the company against a risk that can materially affect its profitability. So 4 main objectives. First one, to protect the company against rising prices. If diesel prices increase again, the hedge can generate compensation. Second, improve cost visibility. We know that visibility is gold today, even more in 2026. This is useful for budget, tenders, customer pricing, etc. Third, to protect margin. And fourth, to reduce earning volatility. Investors, lenders, management team, and shareholders, they generally prefer a more predictable performance. So fuel hedging is not just a financial technique or nice to have, but could be a real business planning tool and could be also a must-have depending on the business model of the company. It helps the company to make decisions with more confidence. So let's now have a look to finish this webinar before the Q&A, because I see that we have some questions. A lot of questions. Let's see an example of a product to hedge this type of risk. The easiest and the usual, because I know I recognize some of the clients of the attendees. For example, on Forex, you used to trade some structured products, meaning everybody knows the forward on currencies, which is more or less the same than the swap here that I'm gonna explain. And then you have the options that you used to trade with us for some of you. On commodities. Of course, we can always, it depends on which commodity we're speaking about, but we can sometimes trade options, but the usual product that all the players in this industry, meaning all the small and medium companies and even the large corporates, I would say that even more the large corporates are using for their financial hedging, it's the swap. So let's take we keep the same same example. So how does it work? For the fuel price hedging, we've identified the benchmark: Platts, ULSD, 10 ppm, CIF, Northwest Europe, meaning that it's the Northwest Europe reference. Then you can see here that the settlement is at every end of month. I will come back on this. The fixed rate, so the hedging rate is 2.79 zloty per liter. Okay, and the most important, maybe, which is the main difference with the Forex, is the reference price. You see that on FX, we're gonna have a look. The observation period, for example, is one day. That's all. And we compare the fixing with your hedging rate. Here, we take usually, because we can structure everything, but usually the clients used to hedge with the average of the months. Why? Because if you are a truck company, your truck or your cars are going to the petrol station every day. So your financial risk is not depending on the price at the end of the month, but the financial impact is coming from every daily fluctuation that you can have. So what we do is that we split the hedge months after months. At the end of the month, for example, at the end of the month of June, we're gonna have a look to the average of the daily prices of the month, and we're gonna compare this monthly average to your hedging rate. How does it work more in details? It's quite easy. For example, if for the month of June, the price, the average of the month, the average of the daily prices of June are higher than 2.79 zloty per liter, you're gonna receive the difference between the average and 2.79 multiplied by the monthly volume that you have you agreed to hedge at the trade date. Of course, we can have linear volume. We can have like very tailor-made volume. So, for example, if you have you are consuming more diesel in July, we can hedge more volume in July and less in August. Everything is tailor-made, and you can fine-tune everything. If the price, for example, let's take the example on the second part of the graph. If the price is lower 2.79 zloty per liter, you're gonna pay the difference. So I can already hear, as I said, some of you. So it means that if the price are going down, I lose. No, once again, the aim and the objective of hedging, same on FX, is to keep to have pretty visibility and to be sure that for X%, let's say 50% of the volume you've decided to hedge, you know that you're going to pay the ULSD 10 ppm only 2.79 zloty per liter. So this is the main and the usual product we use to trade with our clients to hedge fuel oil prices. And if I can give you, to conclude before the Q&A, a quick overview. Here you have in black, the black line, you have the 2.79 PLN per liter. And in white, you have the historical prices of the market index, so the benchmark, the ULSD 10 ppm. And you can see that in average, in 2025, in 2026, of course, the average of this benchmark is higher than the 279. This price, I prefer to say it, if you want to buy it now, it's not a price that Camille gave me today. It's a price that Camille gave me 2 weeks ago. Of course, you know that the market are moving every day. So, of course, the best is to discuss about that, and we're going to refresh and we have some other solutions to optimize. If you want to optimize, we have everything in order to help you in this, let's say, quite complex topic. So, we've spoken a lot, Camille. That brings us to the end of the webinar. Before answering to the question, just to summarize the key points. First, commodity prices are becoming more volatile, and this volatility can last long enough to affect company margin. It's a no-brainer. Second, commodity risk is not only a procurement issue; it's a financial and margin issue. So it's one of the main issues for the companies. Third, hedging is not speculation. It's a tool to reduce uncertainty and protect a budget or a commercial margin. Fourth, the right hedge must be based on the company's real exposure, as Camille explained, meaning that if you buy wheat, you hedge wheat. And so the company's real exposure, the company's real volumes, our goal, and we pay more attention than all the other things. We pay attention to that at Keewe, that we don't want you to be over-hedged. Usually, for example, and this is also something we build with you when, for example, it's the first time you're going to hedge commodities, we help you to at Keewe to build the risk policy management, and it's always better the first time to hedge less than hedge more, honestly. So it's important, the volume, the contracts. That's why usually we can help you to analyze your supplier contracts, and of course the relevant market benchmarks. So dziękuję bardzo first to have listened until now, and I think we have some questions. If I'm not, I just have to open the chat. Camille, can you see the question?
Yeah, I can see it. So the first question is from Pavel. How can I know whether the commodities I purchase can be hedged through your solutions? Do you want to answer, or should
I think the first thing, Pavel, and thank you for the question. The first thing is to call your key account manager at Keewe. They are like, anytime you have any question, you can call. We have Marta here that would be very happy to answer to you. So no, but more seriously, this is exactly what we said. Like this is why we need to study the topic with you. It's not straight to the point as the FX. You know that you receive euro, so you need to sell euro and buy zloty. Here we need to spend the time, so we need to discuss together, and we're gonna help you to figure it out. And to tell you very free, honestly, we can help or we can't help. Next.
I think most of the time also, Pavel, is that if you have a look to your invoice, the physical invoice, the reference of your purchase will be mentioned on the invoice. Okay, so what you can do also is that you can, once you have identified the index, you can ask Pierre and Marta if Marex is able to provide an hedging solutions on this reference. I think most of the time we will answer yes, because we are covering all the underlyings which are tradable on the market. There is very low probability that we are not doing it. But maybe I lie, but I don't think so.
But at the end, you don't lie, because if you're not able to do it now, maybe you're going to be able to do it tomorrow.
Exactly.
Because I see the time flies, so let's go on the second question. I have a question. I've seen that this question has been asked before. I have a question. What do these financial hedging solutions change in my relationship with my supplier? Once again, 99%, I would say even 100% of the time, it doesn't change anything. It's two different things. What we used to say is that legally it's two independent contracts. I would say that it's even better to don't say it to your supplier if you want to say it. But sometimes it's also, I know that I had, maybe it's your case too, Camille. I had some clients that wanted absolutely to have financial hedging. So they asked to their suppliers that were not disclosing any market index in their negotiation when it comes to the purchase negotiation. And they asked if they can be benchmarked, so meaning that they asked to the supplier to give them every month a price based on this market index. Of course, the suppliers has the right to accept or no. But it's also a way to have more transparency and to trust your suppliers. So the answer, long story short, the answer is it doesn't change anything, but it can even help you. So do I need to tell my supplier we answer to this question? So if price go down, is there a high chance that under the hedging structure I would have to make payments every month? That's a good question. If you want to answer, Camille.
So if price go down, is there a high chance that under the hedging structure I will have to make payments? So If you what you have what you can keep in mind is that if you win on the physical, okay. For example, if you buy at 100 and if you sell at 200, okay. If you made a proper hedge, you will the hedging will exactly compensate the flow you have on the physical. Okay, the hedging solutions is the exact opposite you do on the physical side. So normally you are not supposed to win or to lose in each case. There is a full compensation on the physical and the hedging.
Same question for volume. I've not seen the first question.
So I determine the volume I should hedge. So I think Pierre has maybe answered this a bit before. So first, this is your decision, the volume you would like to hedge. Of course, you don't have to over hedge. Most of the time, the clients are hedging a maximum of, I would say, 75% of the physical consumption of the product. Okay, so we will never advise you to hedge more than the physical exposure. Okay, but this is your decision, and we will. If we understand, for example, that you are overhedged, we will of course let you know. That is a risk you are taking, and you should not do it. Also, if you are a beginner in the hedging, I will recommend you to start with a low volume in order to understand how does it work, and to understand the full process, and to identify exactly the flow between the physical and the hedging. So it's better to start with small, and after to do it step by step and increasing the volumes.
Thank you, Camille. I see the next question is definitely for you.
But I don't understand when the commodities are priced in USD.
No. Can I hedge the price of sea freight and shipping routes from China to Hamburg? Okay,
so freight is definitely a commodities we are able to hedge. It's not the commodities which is the most common, I will say, but we have a lot of shipping companies, of course, which are asking us about freight. In the market today, there are different routes from China to Europe. You will be able to hedge. I don't know by heart all the routes. I'm very sorry, Carol. So I will ask the expert of the freight desk if it's possible to hedge from China to Hamburg. But I want to say yes, because as Hamburg is a huge place in Europe for the shipping industry, I guess it's possible. But I will give you through Pierre more details.
Thank you, Camille. I see the question, the next question, but I don't understand when the commodities are priced in USD and your revenue is in euro or PLN, how you manage the currency layer of margin risk separately from the commodity layer. It's a very good question, and this is why even more why it's important for us to have all the details, and this is why being working with Keewe as the one-stop shop is also a strong added value for you, because we are able to advise you on the FX, and we are able to advise you on the commodity, meaning that we are not just have a look to the commodity and like, for example, don't care about the FX. We're gonna analyze the global picture. So for this, Xavier, I think the best if you can You have all our contacts. If you can send me, or I will send you an email after the webinar in order to discuss more in detail about that. But this is definitely the currency something, one of the stage we need to figure it out before trading any hedging, because the goal is not to add you some currency risk hedging commodities. I saw you were competitive on forward. How do yourself and this type of product compare with the competition? So I'm going to answer for the Polish market. The first thing is that we are very happy and proud to be the first and the only one fintech in Poland that is able to offer you commodity hedging. And I'm very happy that Keewe is here, because it's thanks to them, thanks to Marex solution and the incredible work Keewe is doing with us every day. We have already today more than 100 active clients in Poland at Keewe, and a lot of you are interested by commodities. And so I can tell you by experience, knowing a little bit the topic when I was at BNP, that the pricing, the trading capabilities, the product capabilities of Marex is definitely makes them definitely one of the key and the big players on this market. So for the competitivity of our prices, I can guarantee you. And we had some benchmark with Polish banks, but we have very good prices. I think we had only one left. I've seen a question on if you want Keewe to take this one. Working with commercial airlines, I'm wondering what period I should hedge for, and how I can determine the appropriate hedging duration to protect the margin without missing out on market downturns. Not the easiest question.
Okay, so for airlines, most of them, so we are today working with several airlines across Europe. Today we are in a very specific market. So what airlines do at the moment is that depending the hedging solution, the hedging strategies they have in the company, but most of them are not hedging long term at the moment. Today they are hedging maximum, I would say, 12 months forward or 18 months forward. Because they don't want to hedge more longer, because they don't know exactly what will happen over the next months. Also, the current price today on jet SIF is extremely high. So a lot of airlines were very well hedged, and they made hedging before the crisis, so at very good price. But unfortunately, some airlines in Europe has not predicted the situation and didn't think that the war will happen. And some of them, for example, was under hedge for the summer 2026, so what we call July to September. So it really depends of your policy, your internal policy, but I would say that airlines will not take too much risk, and you should not hedge above 18 months forward.
And I see the time flies. I just so Constantine, you can send me an email. I will go deeper in detail, but it works exactly the same way than the fuel oil. Just Adrian, very good question. Can commodity hedging solution to be used indirectly for product or components that contain a high proportion of aluminium, even if aluminium itself is not purchased directly as a standalone commodity? This is a very important part, a question, meaning that, of course, as I said in the introduction, you're not buying aluminium as a standalone commodity, but as you said, in your product, you have a high proportion of aluminium. meaning that you have a commodity financial risk. So for this, we just identify the proportion of the aluminium, and so we identify a volume that you're really buying. So we define like we go deep in defining the commodity risk, and then we can tell you, okay, so the financial risk you have linked to aluminium on your global purchase price is this one. This is the equivalent in volume. So now you have this information. Then you have to define a percentage of hedging, the maturity linked to your business model. If you have long-term contract on the selling side, you can hedge longer. So this is how we do, but it's definitely something we need to discuss together. And I think we answered to everything, Camille. Dziękujemy pani. Thank you very much, everyone. Once again, this webinar will be translated in Polish, so don't be surprised if you if you watch Camille and myself speaking Polish, thanks to the best Polish unicorn 11 Labs. And we're here to answer to all your questions. If you have, please feel free to reach your sales or key account manager to speak about that. We will be happy to help you. And thanks you very much, Camille, for everything. Because if Keewe is able to offer and to be the first to offer commodities hedging to Polish corporates, it's thanks to Marex Solutions. So we are very happy about this partnership and to be able to provide everyone here in Poland this type of solutions.
My pleasure. Thank you very much, Pierre, and all the Keewe team for the invitation. I really hope that we have answered all your questions. And if you have some extra ones, do not hesitate to ask Pierre and or your Keewe expert.
Thank you very much. Do widzenia.
Bye.